Although last week's potential shutdown would have not been the first, its consequences would have been far more reaching given the time and circumstances. One of the reasons is that the economic data releases the Fed uses like a compass to guide the economic ship would have been put on hold, leaving the Fed blind to potential storms ahead or rough waves. Unemployment rate drove higher to 3.8%, the highest since February last year, while core PCE fell below 4% for the first time since inflation became an issue. The equity market closed September, and by it, the second quarter of 2023, far from the heights of July. The S&P 500 shed half of its year gain, which was almost 20% in July, closing Q2 at 11.7%. Similarly, the Dow retreated from its height of 7.5% for the year in July to almost 1% in September, and the Nasdaq followed suit, 37.18% in July back to 26% in September. Latest Fed Open Market Committee projections revealed that the Fed raised its target fund from 4.6% to 5% for the end of next year, conforming the narrative of higher for longer. Meanwhile, bankruptcy rate is on the rise as expected. While the US Treasury yield had a sudden spike by end of last month, after the pause, which was related closely to the potential shutdown again. However, that quickly faded and yield level is back to July level.